Warren Buffett told the world he pays a lower tax rate than his secretary. Everyone heard it. Most people believed it. Almost nobody understood what it actually means, because this isn't a story about millionaires dodging taxes. It's about a tiny fraction of the ultra-wealthy whose money works in a way yours literally cannot. And it starts with one number that breaks everything: the claim. In 2010, Warren Buffett publicly stated that his effective federal tax rate was 17.7%. His secretary's rate sat somewhere between 30 and 40%. The richest man in the room was paying less than the person who scheduled his meetings, and he wasn't lying. But here's the thing, when people heard that, they assumed every rich person in America was pulling the same trick. They weren't. Out of 438,000 households earning over $1 million a year, only about 4,000 paid less than the 15% effective rate middle-income households were paying. That's less than 1% of millionaires. This wasn't a millionaire problem, this was a billionaire problem. Specifically, a top 0.01% problem where income stops looking like income entirely. So Congress proposed the Buffett rule, a minimum 30% effective tax rate for anyone earning over $1 million. Sounds like it solves everything, right? Turns out, no. The projected revenue was $20 billion annually. The deficit that year was $609 billion. That's roughly 3% of the gap, which is, not ideal. The rule wasn't designed to fix the system. It was designed to make it look slightly less embarrassing, because the real question was, never should billionaires pay more. It's what structural mechanism allows someone with tens of billions in wealth to have a lower tax rate than a person earning $60,000 a year, and the answer has nothing to do with income at all. Income versus wealth. Here's the thing that makes all of this possible. It's not some complicated offshore scheme or shady accounting trick. It's one simple design choice baked into the entire tax system. Taxes are calculated on income, not wealth. For normal people, these two things are basically identical. You work, you earn money, that money is your income. And that's also how your wealth grows. Simple. Your boss pays you, the government takes a cut, you keep the rest. The system works exactly as intended, but for billionaires, income and wealth are completely decoupled. They're two separate universes. The Forbes 400 wealthiest Americans report taxable income that represents only about 15 to 20% of their actual economic gains. The other 80%, it just sits there, growing, compounding, completely invisible to the tax system. Let me put real numbers on this. From 2014 to 2018, the 25 richest Americans saw their collective wealth increase by $401 billion. The amount they paid in federal income taxes during that same period, $13.6 billion. That's a true tax rate of 3.4%. Warren Buffett's true rate during those years was 0.10%. Less than 10 cents for every $100 his wealth grew. Meanwhile, the bottom half of U.S. households paid 24.2% of their income in total taxes. The richest 400 families, 23%. The people with the least money are paying a higher rate than the people with the most, which is, not ideal. And the wildest part is, none of this requires breaking a single law. The system doesn't tax wealth growth, it taxes realized income. And when you're rich enough, you simply never need to realize anything. But the income that billionaires do occasionally report, even that gets special treatment. Let's talk about capital gains. Capital gains versus income. Here's where the actual mechanism lives. Not a loophole, not a glitch. A deliberate, legislated, bipartisan feature of the tax code that has existed for over a century. If you earn money from a job, your income gets taxed at rates up to 37%. That's the top bracket. You work, you earn, you pay. Simple. But if you make money by selling an asset you've held for more than a year, stocks, real estate, whatever, that income maxes out at 20%. That's a 17 percentage point gap between money earned by working and money earned by owning things that went up in value. And before you think this is some recent tax scam cooked up by lobbyists in a back room, it's not. Preferential treatment for capital gains has existed for most of U.S. income tax history. The only time long-term capital gains were taxed at the same rate as ordinary income was a brief window from 1988 to 1990, 3 years, out of over 100. Then, they went right back to being lower. The Tax Cuts and Jobs Act of 2017 didn't change this, it explicitly kept the preferential rates intact. Both parties have maintained this structure across nearly every administration since the income tax began. Which is, not ideal if you're someone who earns a paycheck. Here's the thing that kills this is just an American problem argument. Most OECD countries do the exact same thing. Australia and Canada straight up exempt half of capital gains from taxation entirely. This isn't partisan. It isn't accidental. It's a global consensus that money made from owning stuff should be taxed less than money made from doing stuff. So the rate differential explains the gap, but knowing the rates exist doesn't explain how billionaires avoid triggering even those lower rates. For that, you need to understand 3 words that changed everything. Buy, borrow, die. This is the 3-word cheat code that makes the entire system work. And the beautiful, horrible thing about it is that every single step is completely legal. Not technically legal, not exploiting a loophole, legal in the way that breathing is legal. The tax code was written to allow this. Step 1. Buy. You accumulate assets, stocks, real estate, companies. These assets appreciate in value over time, often massively. But here's the thing, the US tax system only taxes capital gains when you sell. So if your stock portfolio grows from 10 billion to 50 billion, you owe exactly 0 in taxes. You haven't made any money as far as the IRS is concerned. You just own something that's worth more on paper. Step 2. Borrow. You need cash to live on. A normal person would sell some stock, trigger a taxable event, and pay up. But you're not normal. You walk into a bank, put your 50 billion in assets up as collateral, and take out a loan at 1 to 3% interest. The bank is thrilled because the collateral is bulletproof, and you're thrilled because loans are not income. You just access billions of dollars tax-free. The IRS doesn't get a cent. Step 3, die. This is where it gets permanent. When you die, your heirs inherit those assets with what's called a stepped-up basis. The tax basis resets to current market value at the time of death. Every single dollar of appreciation that happened during your lifetime, gone, erased. The capital gains tax that would have been owed is wiped from existence. With the federal estate tax exemption at $13.99 million per individual in 2025, married couples can pass nearly $28 million completely tax-free before estate taxes even enter the conversation. Then your heirs start the cycle over. Buy, borrow, die. Generation after generation, wealth compounding untaxed indefinitely, forever. It's not a loophole, it's a loop. If you think this sounds theoretical, wait until you see the actual numbers attached to actual names. Named examples. Let's put some faces to this. Because abstract tax theory is one thing, watching it play out with actual dollar amounts is something else entirely. Elon Musk paid 0 federal income tax in 2018, not reduced, not minimized, 0. The year before that, he paid $65,000. In 2015, he paid $68,000. Now, $65,000 sounds like a lot of money until you realize it represented less than 0.01% of his annual wealth growth that year. That's like finding a nickel in your couch and declaring it your life savings. But Musk at least had some tax years where he paid something. Jeff Bezos paid 0 federal income tax in both 2007 and 2011. His true tax rate from 2014 to 2018 was 0.98%. And here's the beautiful part of how he pulled it off. His salary at Amazon was $81,840 a year for over 2 decades. The guy running one of the most valuable companies on earth took home less than a mid-level accountant in Chicago. On paper, he barely qualified as upper middle class. Meanwhile, his actual wealth grew by tens of billions annually, completely untouched by the income tax system, because none of it was income. Then there's Warren Buffett, the man who started this whole conversation by pointing out he paid less than his secretary. His true tax rate from 2014 to 2018 was 0.10%, less than 10 cents for every $100 his wealth grew, not 10%, 10 cents per $100. I don't know what to tell you. And none of this is illegal, not $1 hidden offshore, not one fraudulent deduction. This is the domestic tax code functioning exactly as written. Bezos shows the salary trick, Musk shows the $0 years, Buffett shows what happens when the strategy compounds over decades. But knowing that these individuals pay virtually nothing raises an obvious question. If the system is working as designed, who designed it, and why does it stay this way? The political economy. So now you understand how it works, the mechanisms, the loopholes, the strategies. But here's the question nobody seems to ask. Why does it stay this way? Because it's not like voters are out here demanding lower taxes for billionaires. Most Americans, when polled, overwhelmingly support taxing the ultra-wealthy more. So what gives? Here's the thing. The people who benefit most from this system have an almost unlimited budget to maintain it. Elon Musk donated over $277 million to Republican candidates and POTUS during the 2024 election cycle alone. That made him the single largest political donor in America. And he's not an outlier. The wealthiest 1% of households have provided 40% of all campaign contributions since the 1980s. That's not democracy, that's a subscription service. But direct donations are only half the story. The real genius is in the framing, take the estate tax. When researchers asked Americans whether they supported taxing large inheritances, most said yes. But when the exact same policy was reframed as hurting family farms and small businesses, support collapsed. Same tax, same policy, different name. Suddenly everyone's worried about some hypothetical farmer named Earl losing his tractor, which is, not what's actually happening. Meanwhile, the federal estate tax exemption nearly tripled from $5.49 million in 2017 to approximately $13.6 million in 2026 under the Tax Cuts and Jobs Act. and that's 13.6 million per individual, over 27 million per couple. That passes completely tax-free. Earl's tractor was never in danger. But the framing worked anyway, and then there's the sheer futility problem. The Buffett rule, which would have imposed a 30% minimum tax on millionaires, was projected to affect only 116,000 households. It would have raised $20 billion annually. Sounds like a lot until you realize that's roughly 1.5% of the deficit. Politicians looked at the lobbying costs versus the revenue gain and went, yeah, not worth the fight. Which is exactly how the system sustains itself. Make reform feel pointless, make the beneficiaries powerful, and make the public argue about farmers instead of billionaires. But if the political economy explains why this persists, the next part explains something even more uncomfortable. That maybe it was never supposed to work any other way. Why it's not a bug. Here's the part that nobody wants to hear. Everything I just described, the capital gains rates, the buy, borrow, die loop, the stepped up basis, none of it is a loophole. None of it is an exploit. The system is working exactly as designed, and I can prove it. The stepped up basis provision has existed in the US tax code since 1921. That's over 100 years. Every single administration, Republican and Democrat, has looked at it and said, yeah, that stays. It survived the New Deal. It survived the Reagan era. It survived Obama. It's still here. That's not an oversight. That's a choice, made repeatedly for a century. But here's where it stops being a US problem and becomes something harder to dismiss. Almost every developed country on Earth independently built the same system. Australia formally exempts half of all capital gains from taxation. Canada does the exact same thing. The OECD conducted an entire study on capital gains taxation across its member nations and concluded that these systems undermine equity, introduce economic distortions, and constrain revenue-raising potential. Their words, not mine. And then every single member country kept doing it anyway. When one country gives preferential treatment to capital income, you can call it a quirk. When dozens of developed nations independently construct the same architecture, that's not an accident, that's a blueprint. The Forbes 400 effective tax rate dropped from roughly 30% in the early 2010s to 23.8% by 2018-2020. That's not entropy. That's not drift. That's a deliberate downward trend, legislated into existence by people who knew exactly what they were doing. So the next time someone tells you billionaires are exploiting loopholes, understand what that framing does. It implies the system is broken. It implies someone is cheating. It lets the architects off the hook. The uncomfortable truth is simpler than that and says the system isn't broken. It was built this way, by the people who benefit from it, for the people who benefit from it. Not all stories have a moral. Sometimes they're just math. If you enjoyed this video and want to see more, click the video on the screen now.